I'm sure you've heard investors talk about bear and bull markets, and you've probably thought to yourself, what are they referring to? What is a bull market? Well, in this video, we'll be talking about bull markets specifically and how they have historically impacted the financial markets over time. Let's get started. Defined simply, a bull market is when a financial market experiences a rise in both value and investor confidence over a period of time. This period of time differs and can be anywhere from a few months to several years. What factually and numerically constitutes a bull market is kind of tricky to define because there are multiple interpretations, and bull markets are often determined in hindsight. One of the most commonly accepted interpretations, however, is that a bull market is when the market increases by 20% after the market has experienced two declines individually of 20% or more. While we all like numbers in finance, it's also important to consider the realistic truth that percentages up and down aren't the only thing that determine a bull market. Investor confidence and optimism are key components as well. The psychological component of bull markets cannot be understated, as it is the willingness of investors to create significant buy pressure on stocks that inherently generates the momentum for a bull market because the demands for stocks exceed the supply of stocks being sold. This psychological element really rings through during bull markets because what happens is the news cycle brings in new investors and old investors alike back into the markets during the excitement of this bull market. They want to make money. They want to be a part of it. They don't want to miss out. The fear of missing out is an important element. And so they continue to invest. They put their money in, creating additional buy pressure on the stocks, causing them to rise, causing the markets to rise, perpetuating the bull market itself. This generates more buying volume and general optimism, which overall ends up feeding back into the bull market mentality. The idea behind the terminology of a bull market comes from, well, the bull's horns, which stick upwards. And when a bull rushes forward, it rushes forward with incredible strength and momentum, exactly what you'd hope to see in your stocks in your portfolio. Conversely, compare that to a bear market. Bears tend to slash things downward. They also dig into dens and go into hibernation. They're passive, they're sleeping, they're quiet, they're not moving. That is the opposite of what a bull does, and that is where you get the terms bear and bull market. The term bull can be often used to describe somebody who believes the stock market will perform over a given period of time. For instance, someone can be bullish on the overall market. They can be bullish on a particular sector, or they can be bullish on a particular stock. For example, I might be bullish on the energy sector. I could be bullish on Tesla. That means that I think that these commodities or these stocks or these sectors will perform well over time. Conversely, a bear is pessimistic. They believe that the stock market, a particular stock, commodity, or sector, will decrease over time. They believe that there is a lack of momentum. And the most interesting conversations are often happening when bears and bulls meet. Historically, the longest North American bull market was from 1987 to the year 2000, lasting over 12 years and generating 582% gains over that time frame. Absolutely incredible. In comparison, the shortest bull market was started in 1932 and lasted only 14 months, but it ultimately generated 177% gains for the investors at that period of time. If you'd like to learn more, be sure to check out this playlist, which is essentially like a video dictionary of important terms in finance. Thank you so much for watching, and we'll see you in the next video.